Hi, everyone. Thank you for joining us today. I'm Marcia Butler, and I'm the webinar director here at Advice Chaser. We're so glad to have you here. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during this event, we'll make sure someone reaches out to you after today's webinar. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material today. I'd love to introduce you to our presenter today. Brenda Bridges is a financial advisor, mediator, certified divorce financial analyst, retirement income certified professional, and certified divorce coach. She's also the founder of Bridging Divorce Solutions, which helps couples divorce by implementing a non-adversarial process, one that is not financially confusing and not unreasonably costly. Using alternative dispute resolution instead of or in addition to the court system means families can own their decisions and design their lives during and after divorce. Brenda and her team believed in changing the unknowns of divorce to an understandable and streamlined process, morphing fear into hope and questions into confidence. And Brenda, we're going to go ahead and turn the time over to you.
Thank you, Marcia. And thanks everyone for being here. Today we're talking about something that tends to be very confusing to people as they approach divorce or go through the process. And our intent in this webinar today is to clear up some of the myths and misperceptions with the caveat, and we'll get into it as we go through the presentation. You always want to check to make sure what the rules are where you live. I think I said it before, but I saw a quote somewhere that said something to the effect of, and I'm going to get the number wrong, there are 3,412 counties in the United States, meaning there are 3,412 different rules about how to get divorced. So you just want to be sure about what the standards are in your area, and that you're asking the right professional the right questions. So we're going to talk a little bit about that now. Oftentimes people will only use an attorney in their divorce. I'm, as a financial professional, an advocate of also use a financial professional. Attorneys are experts in law, and financial professionals who are trained in the process of divorce can really pay for themselves and help you avoid mistakes, both short and long term. So that certification, I'm a CDFA, Certified Divorce Financial Analyst. And what that means is we've gone through a pretty rigorous course and testing specific to finances in divorce, which are really different than retirement planning or something you'd go to your regular financial advisor for. Another thing that you want to look out for, if you do work with a financial advisor, there is an inherent conflict of interest as you're going through divorce if they represent you and your spouse on any accounts. So it's something that can get tricky if they both aren't trained in the finances of divorce. And by definition, when you're getting divorced, you have separate interests. So you just want to be careful if you're working with them and continue working with them, all fine and good, but to have them help you make the financial decisions in divorce might just be a tricky spot to be, as they are working with both you and your spouse. So that's something to really be aware of, that conflict of interest. Attorneys know the law of divorce and how to represent you in your area as far as that's concerned, but they might not have an eye towards the most efficient way for you to separate your assets. I've certainly worked on cases where we've saved people a lot of money with the same end result just by rearranging what they're doing in dividing both assets and liabilities. So that's not always taken into account from the legal point of view. And that could be here we have it, the order in which you're moving those assets. It can definitely be beneficial at times to be thoughtful about that. You can actually save money by transferring assets in a specific order, especially if they're retirement accounts, because there can be a benefit to one person in not having penalties as they take that money out in a divorce that you can lose if you do it at the wrong time. You can also have tax implications that you might not be taking into account as you're dividing things. So you want to make sure that that is being looked at. So an example I often give is, let's say you have $100,000 in a checking account or savings account, you have $100,000 in a retirement account, and you have $100,000 of equity in your house. They're not the same $100,000 because of tax. So it can be, a $30,000 swing. So some person thinks they're getting 100,000, and in actuality, it's 70,000 because of taxes. So you just want to be aware of that. You also need to make sure that what you intend to do in your settlement, in your agreement, can actually be done. So I've run across, more often than you would think, situations where people come to an agreement, so they have their settlement, and from a legal perspective, it looks all fine and good and everyone is ready to move on, or does move on. It can even be filed this way. But when you actually look at, can we do what we said we were going to do? There are times when you cannot, because the pension plan or the plan sponsor, whoever is holding that investment, doesn't allow you to divide it in the way you intended to divide it. So just another reason to have a fail-safe and a financial professional. So next we have, so we talked a little bit about this. As you're looking at dividing your assets, it's not only your jurisdiction. That's very important, because different places have different rules, and you'll hear words like equitable distribution. So a state that's an equitable distribution state wants things to be, I hesitate using the word fair, but they're kind of with an eye towards, is this okay for both parties, versus a 50-50 distribution state where they're just dividing it down the middle. And then you have to look at what you're actually dividing, what is marital and what is not marital. But in an equitable distribution state, the way a court or judge might look at what you're dividing, they might feel that 60% to 40% or 70% to 30% is an equitable way to divide your property. So if people are going in thinking, it's a given that everything is going to be divided 50-50, and then they pursue divorce through litigation in a state that has equitable distribution, it might not be 50-50. So those are things that you want to get real clear on at the beginning of the process. What can happen is, if someone believes that they have the right to 50%, but in actuality, that's not what the law upholds in their area. With caveat, I am not an attorney. I'm a financial advisor who specializes in divorce. So we're talking about the money of divorce. But if someone has the perception that they will get 50%, And they are spending a lot of money, time, fees, effort to fight for that when in actuality, a court would make a different decision. You can actually waste a lot of money pursuing something that wouldn't happen. And it works both ways. If you're in a state where almost everything is always divided 50-50 and you think you should get more, but you just think you should get more, and that probably would never happen in a court, you can also spend a lot of time, money, energy fighting for more than you would likely get. So those are things that you want to touch base with as CDFA and attorney in your area, just for a reality check as to what expectations would be, because you can save yourself and you're going to be ex-spouse a lot of angst and a lot of money by being clear on what is likely to happen. Now, we also wanted to talk about the methodology you choose for divorce. If you're litigating, even if you don't end up having your settlement decided by a judge, and the majority don't, even in litigation, I think it's around 95%. So let's say 90 to 95% are decided outside of the courtroom. It's still under the umbrella of what would happen if you are in a courtroom, and the negotiations are taking place between attorneys for the most part. There's less room for, let's say, creativity or flexibility in how you divide things. If you're mediating, it's an out-of-court private process. Collaborative process is the same, that gives you more flexibility to be goal-oriented. You know, what do we need our lives to look like, and what do we need our financial situation to look like after we're divorced, as opposed to only looking at, this is what the law says where we are. So just bear in mind, if you're going through divorce, or if you haven't picked a process yet, picking the process that best matches your situation, both financial and family, can be much more effective in the long run. We also made a note here that you can get very detailed in your financial arrangements, and there are professionals that is all they do. They, a forensic accountant for divorce cases would perhaps spend all of their time digging into the details to validate the financial situation. Business valuation can be the same thing. That can get very costly. So if you're in that situation where you might not be in a position of trust as you go through divorce with your spouse, you think things aren't being disclosed, there are degrees to which you can kind of hunt down the missing pieces. It's really hard to hide things. You know, there's an electronic trail, there is a paper trail for almost everything, unless you're in a cash business or do a lot of barter. But otherwise, professionals can look at pay stubs and tax returns and statements and 1099s and K1s and business books and on and on and on to figure out what the financial situation is. A forensic accountant is going to be the best trained to really get in the detail of it. But a CDFA or a CPA, another professional, might be able to do enough of that work for you without the great expense of what can run into tens of thousands of dollars for an accountant to dig into the details of a financial situation. And next, so where you start by looking at what you have, because you kind of have to get it all on the table in order to decide what to do with it as you're separating your lives and your finances. The first level that you would look at is sorting by what is actually a marital asset and what is a premarital asset. And here, professionals can help sort this out as well. But it can be something that, again, people have misperceptions about. It can also be things that are, especially for a long-term marriage, kind of hard to prove. So you have to look at, is it worth our while to dig into what is premarital and what is marital, what is separate property and what is not, because that too can get expensive to dig into. But the rule of thumb is going to be, If you had it before you got married, it is premarital. If you had it before you got married and then you spent it on something, say a down payment for a house that is joint, then it becomes marital. It's considered basically a gift to the marriage. There are cases where you can actually track back. So let's use the example we have down here as the 401k. So say you have $100,000 that was in your 401k before you got married. And then you get married and you continue contributing to that 401k. So for another 10 or 20 years, it's going to be a mix of marital and premarital or separate property. So everything that was in there up to the point you got married, that $100,000, that's premarital. But every contribution past that point is going to be considered marital, as well as the growth, if there's growth on that $100,000. So you have to decide as you go through the process, what is it worth to separate that out? Sometimes a professional can go back through the statements and come up with a figure. Other times it gets pretty sticky, determining where the line is. So you just want to be sure you're looking at what is the return on investment. If it's a potential of maybe $20,000 that is in question, and you're going to spend $25,000 to figure out who that $20,000 belongs to, you might want to take pause and not go that route or not go in that direction. So ask the questions as you go through your assets, not only who does it belong to, but how much would it cost for us to figure out who this belongs to? Like, is it worth the fight? Is it worth the investment? So other ways you can look at premarital or marital. Generally, if it's an inheritance or a gift, it's individual property, even if that comes to you when you're married. And if you use that inheritance for something that is marital, again, gift to the marriage, it's no longer your inheritance. So people find themselves in a situation where maybe they got a $200,000 inheritance from a parent who passed away and they're married. They can take that $200,000, put it in a separate account in their name only, that remains separate property. But if they take that $200,000 and they buy a lake house with it, that is titled for both parties, it's no longer separate property. It's now joint property. So as people are going through a divorce, that's something that they need to split up. And a misconception is people at the time of divorce will say, oh no, that $200,000, that's mine, I get it back. And again, don't want to tread on the legal line here, but from a financial point of view in divorce, that is probably no longer yours. That is probably joint property. So it's better to know where you stand, I would say, and what the law will uphold, rather than going under the misperception that, oh no, that is mine and I'm going to fight for it and spend a lot of money in legal fees, when in actuality, the law is probably not going to uphold that that is your separate property. So ask the question of your attorney. Let's see, student loan debt. This one is a little trickier because oftentimes the student loan debt is spent on an asset that gives the person who took out the loan a benefit that allows them to then, we hope, earn more money. So student loan debt may or may not be considered joint property if it's incurred during the marriage, but the person who incurred the debt then has a medical degree that they can go on and earn a significant amount of money with, then they might take that debt with them as opposed to looking at it as joint. So some of it, you need to look at the law, but you also kind of need to look at the common sense aspect of it. So someone who didn't get the benefit of the education be saddled with the debt for an education that remains kind of like an asset with the other person. So take that into consideration. So we talked about what you have. Business ownership, more and more, as more people are venturing out on their own with their own businesses can also be a tricky thing. You can look at it different ways. So as you go through your divorce process, you have to first get on the same page as to how you're looking at that business. So example might be, say you have a retail store that does $3 million in revenue. One party might say that's a $3 million a year business, except they have to pay rent, they have to pay utilities, they have to pay the cost of goods, they carry inventory, they have payroll. So maybe the person running that business just takes home $50,000 in income. That's a huge variance between $3 million and $50,000. So working with a financial professional, you can come up with ways to agree on truly valuing the business. So in that example of the retail store, it's going to be what you can sell it for, right? What if you were going to, first of all, does it have value to sell it? So this example we have is, let's say you're a dentist, not a retail store. Your practice is, the value you bring to the practice is the individual who has the skill set, right? The dentist. If the dentist leaves, you can sell the chairs and the drills and the equipment, but that is really likely the only value of that business, could be the only value of that business, versus a manufacturing plant where it doesn't matter who the person is running those machines, they're still going to kick out widgets, they're still going to have a value. So it's not inherent in the person. So another example would be something like, someone owns a Taco Bell franchise. No one cares who owns that. It is a viable business that has a freestanding value, versus maybe someone is an artist. The value is only in what that individual person produces. And if they choose to not produce art anymore, there is no value to it. So you have to look at kind of what it could be sold for versus an assigned value in your head, maybe of what a business could be. Something I ran into recently was someone who's a contractor, so there were some tools that he owned, but really he was the only value to the business. There wasn't something inherent that could be sold to someone else. So then you have to look at that as an income stream, as opposed to, oh no, it's a marital value business that someone can pull money out of. We talked a little bit about equitable distribution, and it is just that. It doesn't mean 50-50. If someone doesn't have the ability to earn an income, maybe they've stayed at home and taken care of the household for decades and haven't worked, so the at-home parent re-entering the workforce, they might never be able to catch up income-wise to where they would have been had they been working all along. So they might get a much greater portion of marital assets because another person who has been working outside of the home and earns a significant income has the chance to catch up. So they're looking at distributing the assets for the family in a way that, does the least harm and gets both parties on more level footing, which 50-50 might not do. Child support. This is something that I frequently hear one party or another say, I'm not paying it. And this is something that it is highly unlikely the courts are going to agree with anyone saying, I'm not paying child support. The court system, and divorce is a legal process, right? They want to make sure that children are taken care of with the least impact on their standard of living as possible. So for one party to say, I'm not going to pay it, probably would be frowned upon and highly unlikely. Most states have a formula. So there is a child support calculator. Different states might use different rules or different calculations to figure out what that is. But more than likely, they're going to look at the income of both parents. And based on that state's formula and the number of children, come up with, here is the number that one parent will pay to the other to cover food, shelter, and clothing. And that's another misconception. Sometimes the person who is the payor, so they're paying child support, thinks that, okay, now I don't have to pay anything else. My child support is to cover everything, but it's really not intended to cover everything. It's intended to make sure that child is fed and clothed and has a roof over their head. But if they have an activity that, so extracurriculars or school tuition and fees, any camp, any number of things, phones that, that cost money, that can be incremental to and should be addressed in your parenting plan. Incremental to the child support amount. So as you go through the finances of your divorce, you want to make sure that it's being addressed as you make your agreement, so that afterwards, the person who is paying doesn't think, oh no, that's it. And little, Johnny's need for a calculator for school, that's on you, the recipient, and it comes out of child support. Make sure that you're clear on how that's going to be paid, especially, if you have young children, you could be looking at 10, 14, 16 years of expenses that get more expensive as the child gets older, that you want to have some kind of mechanism for who is paying and what percentage and how are we going to determine it, and on what time schedule is it going to be paid, so that you know what you're dealing with as you're raising children and funding them. And it creates less friction in parenting overall, because you've already decided and you're not constantly going back to your then ex-spouse, figuring out how you're going to allocate funds or decide what is okay and what is not okay in expenses. Child support can be modified. So if someone suddenly makes much more income, then that child support amount might go up. If someone makes less income, that child support amount might go down. If someone chooses to not work, so they are electively underemploying themselves, that is frowned upon, and it's likely that you'll end up in court, and it's likely that the court will see through an underemployment situation. So it's not a great idea, because it will probably not work in the person's favor who's doing it. Certainly not the best thing for the child. And you'll end up with more legal fees and probably still have the same child support payment or thereabouts. So think of it as it's flexible if circumstances change. And those circumstance changing is not your choice, especially if it's for the negative, but it's not really flexible if you're choosing to change your circumstance. Doesn't work that way. And next we are going to talk about spousal support. Spousal support has much more flexibility than child support. Different states, different rules. Some states go by formulas and it's pretty cut and dried. Other states have no formula whatsoever, and it is absolutely on a case-by-case basis. And again, I take you back to what we were talking about at the beginning, litigation versus an out-of-court, more collaborative form of getting divorced allows you, especially if you're in a state that doesn't have guidelines, it allows you to then take control of your situation. Ideally, two spouses are able to look at their financial situation moving forward and figure out how they can both be okay financially. It's, how do I say? It doesn't always happen, I guess is the best way to say it. But there's a big roll of the dice if it doesn't, because you don't know when you're in court what that judge will decide. You don't know, how they're feeling. You don't know, like, maybe you're the fourth case that they've seen with the same fact pattern and they don't even listen to you and they just go, this is what we're doing. Maybe they're having a bad day and that impacts your situation. Maybe they're new to family law and they deviate greatly from what traditionally happens in your jurisdiction. You just don't know. So you're leaving a lot up to chance if you let the courts decide what spousal support would be. And again, it can go either way. You as the payor might end up paying much more than you would have had you decided out of court, or much less, in which case then your spouse is not getting enough and might not have enough to live on, which, especially if you have children, can impact their quality of life. So you just want to take it all into account if possible. And you can work with a CDFA, work with your attorneys to figure out what the need is for spousal support versus a random number, let's say. There are different ways that spousal support can be paid throughout the country. It tends to be leaning more and more to rehabilitative spousal support or alimony or maintenance. It goes by different names in different areas. So that is an amount of money that then allows the person who is the lower earner to increase their ability to earn, their chance to earn. So it might be, someone who's been out of the workforce and needs additional training. They might get an amount of maintenance to allow them to go back to school so that they then can earn their own living. It can be an income stream, so a regular monthly payment of a certain amount for a certain duration. And that is in formulaic states spelled out by, you've been married for this many months, you get this many months of spousal support. It's going to be figured out by this formula. In other states, you can decide it or a court can decide it, whether it is awarded or not. There is such a thing as, it's called permanent spousal support, but it's not necessarily permanent. So another misnomer, if you will. So for a long-term marriage, they might award permanent spousal support. But when you think about it from a common sense point of view, is the court going to make someone continue to work for the rest of their lives in order to pay someone else spousal support? Probably not. So permanent might just be up to the point of retirement at a reasonable retirement age. So, back to the common sense, for someone to say, I'm going to retire when I'm 55 in order to not have income, in order to not pay you spousal support, not likely. But at 65, highly likely. So you just want to bear that in mind as you're determining it. Spousal support, you can also come up with calculations and be a little bit more creative about it. If you have enough assets, one spouse might buy the other out, or you might trade, in essence, equity for the house for spousal support. So there are ways that spousal support can be awarded or can be accounted for that isn't a monthly payment for a set duration of time. So a CDFA can help you figure out if that's likely or if that's possible. And then there's also math that can be done, because if you're figuring out how to change an income stream over, let's say, 10 years, it's not that, say it's $1,000 a month for 10 years. It's not 1,000 times 12 times 10. There's a value to that money that's present value calculation that's actually going to be less, because we're figuring that the person who gets that lump sum is able to invest it and then earn money on it. So you can take those things into consideration. Another thing you can take into consideration and need to look at, if you are trading off an income stream for a lump sum, you have to be able to access the lump sum. So if one party is saying, I don't want spousal support or alimony, I will take the 401k, but they're only 40 years old, it's going to cost them penalties and taxes in order to access the money in that 401k, and that should be accounted for. So you want to look at things like, look at it from all different directions to see what the impact or ramifications are. Another thing that I've done on occasion is work with people, and again, this is like a more creative solution. Maybe you delay the spousal support. Maybe both parties agree that yes, this is deserved by one party, but they're just not in a financial situation to pay it at that time. So, and this was an example that that I worked with this last year. It was very important to the parties to keep their children in private school, but the cost of the private school made it not financially feasible to pay spousal support. So they just delayed it. You know, you look at the private school payments, and then once those are done and the kids have flown, then they added in spousal support down the road. So you have options. It doesn't have to be, you know, this is the one and only way, this is cut and dried. If you look at your needs in addition to what you have, then you might be able to come up with some more creative ways that suit both parties as you move forward. Oh, touched on this one. This is super important. You want to make sure that you're looking at the cost of the asset. So taxes are costs. We can't avoid them. They're going to happen. If not now, then later. So you want to look for everything you're dividing. What, if any, are the tax ramifications, and make sure that in your formula, as you split things up, you're taking that into account and equalizing it. So when I run through reports, I do one report that is not tax affected, and I do another that shows, and this is the after tax effect. You would be amazed at how much of a swing there can be when you look at it the different ways. So whomever you're working with as a professional, make sure that they are looking at the tax effect both ways, and not only now, but down the road. Because taxes on a 401k, you're not going to pay until you start withdrawing, motorcycle out there, until you start withdrawing the money, but you're still going to have to pay it. So take it into account in your settlement, and different things are taxed different ways, right? So investments that aren't retirement accounts, those are going to be capital gains taxed, short and long term. So that's more of an immediate taxation. Retirement accounts are going to be taxed when you withdraw it in retirement. But if you need to withdraw it prior to retirement, you may or may not end up paying penalties and taxes. There are ways that we can structure retirement accounts during divorce to not pay the penalties. But you need to look at it before your settlement is final, so you know if you can do it, and you know what the ramifications are, what the cost is. And you set it up correctly, because if you don't do it correctly, the IRS doesn't like that at all, and they will come get their money. Tax implications, the same. You want to look at pensions, what the implications are there. Real estate may or may not be taxed, depending on, did you see a capital gain? Have you had one in the last 5 years? Are you splitting a capital gain versus taking it individually, because that's 250,000 versus 500,000 for a couple. So you just want to look at how that's structured. And if you intend to sell real estate, especially a marital home during divorce, what are the implications of that? And there are some, again, creative, but mistake-laden ways to, if one party rents back the house from the other party, and I don't want to get in the weeds on this. There are just ramifications if you're structuring something where one of the spouses stay in the house and the other spouse owns the house. You want to make sure that you're not breaking any rules as far as claiming capital gains or residency when that house is finally sold. And there are really specific rules pertaining to divorce about that. Businesses and how those are taxed. If the money is left in a business, it's not generally taxed at that time, but it might be later. So you just want to take a look at that. Executive compensation, especially if it's an international company, whole nother ball of wax. You want to make sure you're taking that into account in your settlement, how it's looked at, what part is marital, when it is vested. So there are certainly different schedules that can be put together. So as these, so executive compensation, it might not be vested for 5 years, making up time or over a schedule of time, but it still might be marital. So you want to make sure that in your settlement it's accounted for and it's clear as to what is or is not marital, how it's going to be dispersed. Is it going to be, if let's say it's stock, do you get the stock or does the stock have to be sold and then you get the proceeds? And in those proceeds, how are they going to be transferred and in what time frame? And what if the stock is sold and then it's not transferred for, I don't know, a couple of weeks and the market crashes? What value do you get? You need to look at all of these different what ifs in your settlement so that you're clear on what is supposed to happen. There's a time frame to it, and you don't land yourself back in court because of a miscommunication or a misunderstanding as to how this was supposed to unfold. Another thing is funny, it just came up today, is collectibles and how are they assessed or valued and how are they distributed. And sometimes this comes up in, and I think we have this probably on the next slide, just the emotional attachment to collectibles as opposed to the financial value of those. So let's see, it's the next slide, the one about, material things. So there often is an emotional attachment that clouds the value of whatever the item is. If it's a true collectible, and I've run into people, coin collections, artwork, jewelry, that indeed might have a high resale value, but it may not. It might have a more inherent emotional value. But let's just say a worn sofa, someone might think, we paid $10,000 for that sofa, that's what it's worth. In that case, the thing, whatever the thing is really only worth what you can sell it for. So you need to take a look at what the real value is. Is it a diamond that has resale value, or is it a sofa that you might need to pay someone to haul away? And what is it worth as you divide things to come to an agreement over dividing the things? So that's the material things are kind of have a reality check there. This is my kind of soapbox thing. Marche's heard me many times talk about this. You need to make sure you can do whatever you've agreed to do. You don't make the rules, especially for retirement accounts. Whoever the plan sponsor is, meaning whoever is the employer or entity that offers that account, makes the rules as to how and whether you can divide the account. If you agree to divide an account and then you get divorced and your divorce is final, and then you go to divide the account and the plan sponsor or sponsoring entity says, nay, you cannot divide that account, it might be over. You might end up back in court and you might win. Or if the spouse who is the participant says, aha, now all that is my money and I don't have to divide it with you, the person who intended on receiving the money and it was the intent of the agreement may never see it. So this is something you don't do the quadro. So a quadro is a qualified domestic relations order. And that is the legal way that a retirement account, which is an ERISA account, is split. So that's different than an IRA, right? An IRA is an individual retirement account, totally different rules. So think of a company retirement account or an employer retirement account. You need to make sure that you're able to split that before your divorce is final. So if you aren't able to split it, you can come up with an alternative way to handle the intent of two people sharing that income. Yeah, and my soapbox is just do it before it's too late. After your divorce is final, when you are sure that you can split it with a quadro, or in some cases it might take another mechanism, then you can go ahead and split it. But you have to make sure it's doable before your divorce is final. And then don't wait. So if someone knows that by agreement, they should get 50% of their ex-spouse's pension or 50% of their 401k, and then they sit on that agreement for years and it happens, then it gets more and more difficult and very sticky as to when they move on and try to get those funds in their own name. So do it as soon as possible. If you don't, you run into things like, what if the market goes up? Who gets the gain? Did you account for it? What if the spouse who is holding those investments makes some radical changes and makes it much more aggressive than you want it to be, and the market goes down? Do you take the loss? There are a lot of what ifs. It's always better to get it in the name of the new participant, if you will. So each party then has control over their financial destiny and their financial assets. And you don't run into not good surprises down the road. Other things to take into account. So say you have a pension, or you have a retirement account, or you have spousal support that is going to be owed from one to another over a period of time. You also want to take into account what happens if that person passes away too soon. Are you going to build in some assurance, which can be insurance, to make sure that you are paid, or that child support is paid, or that assets are divided? And you want to look at the ramifications, and things can come into play. So let's look at a pension where you agree to divide a pension and the pension is divisible and you do all the right paperwork, but the person who was the participant passes away before they start drawing in the pension. That pension might go away completely, even though you did all the right things. So you want to walk down the road of what if, fill in the blank. What if something happens that is unforeseen? Are there protections built into your settlement agreement so that you make sure you're covered if you are counting on that money to live, or those assets to live? And you can structure things like, we have laddering here. So say one party has life insurance and they, as part of their agreement, are carrying life insurance in case they pass away, for their child support obligation, or for college obligations for the kids, or for alimony obligations. That obligation gets smaller over time, right? So it's a different, if you have 10 years of spousal support and you're 5 years in, it's not the same amount of money. So by laddering, what you can do is structure so that the amount of coverage or protection that you're carrying, that one person is carrying for the other, lessens over time. So then their expense to keep that lessens over time. So it's just one way of looking at it. But you want to make sure you can do it again, because some policies don't allow it. And then you need to put multiples into place. So we talked about what'll happen if the payor passes away. You want to walk down the road and make sure you're covered. So again, you're not surprised. And another really important thing post-divorce is to do your estate planning. Do a trust, have a will in place, have power of attorney. So if you've been married for a long time, your spouse automatically had power of attorney for your financial and your healthcare decisions. Once you're single, who do you want to make those decisions for you? So ideally, you name a financial and a medical power of attorney and have that on record and known, so that if you yourself are in an accident, the hospital isn't making decisions on your behalf. They don't know you. They don't know what your wishes would be. So you want to take care of that in event that something happens to you and your spouse is no longer the one making the decisions. You can look at it another way. Normally a spouse is a beneficiary for all accounts. So once you're divorced, do you want your ex-spouse to still be your beneficiary, or do you want to revisit all the things that might be your assets and possessions? Where do those go? How are they dispensed? And is that our last one? Oh no, liabilities, another important one to talk about. So we talked a lot about assets. Liabilities are marital as well. And a misconception or misperception is that, oh, my name's not on it, it's not mine. So if someone's spouse takes out a HELOC or takes out a car loan or takes out a bunch of credit cards and takes on that debt, if you're married, that is marital debt. So you can work out your settlement so you don't keep that debt, but if you don't address it, it is still yours. So you want to make sure as you're going through this process, pull a credit report for both of you, see what is out there, make sure you're clear-headed on what debt exists and how you're dispensing of it. Is it going to be settled as part of your arrangement? Are each of you going to take a portion of it? You can also look at the second point here is if one party is incurring debt that is not marital in that they're spending it on another person. So if one party is having an affair and they're, spending it on trips or hotels or dinners or apartments or what have you, that can be considered a dissipation of marital funds and be paid back to the spouse, because basically they're not approving of the money being spent, so they are owed it back. So that's one of the ways a liability might be looked at a little bit differently than if someone just went out and bought a sports car. You're basically, when you're going through your divorce settlement, you're looking at a marital balance sheet. So you're looking at all your assets, you're looking at your liabilities, and then you're determining how you split them up. So you can offset the assets on that marital balance sheet with the liabilities and kind of wash it out that way. We talked about educational debt already, and business debt can be a toss-up. It can depend on the nature of the business, at the structure of the business, but you want to make sure that it's addressed. So if you are not the business owner, you're aware if there is debt and how it stays associated with the business, so it doesn't follow you post-divorce. Mortgage can be a really interesting one. Usually it is the biggest debt that we have, and it's usually associated with the biggest asset that we have. Especially in what is now a higher interest rate environment than we've seen in a really long time. We'll talk a little bit about creativity. It is not absolutely mandatory that you refinance the house upon divorce, as long as it's addressed appropriately in your settlement. So if one party doesn't intend to buy another house, they intend to rent, then they might, if there's enough of a level of trust, they might leave the mortgage in place. They can file what is called a quitclaim deed. So they give up rights to the marital residence, they give up rights to the house, but they've structured it in so the person who is staying in the house has the old mortgage, and that can right now make a huge difference in cash flow, in what is affordable for both parties. So I know we're kind of coming up on the end, but just know that there are ways to deal with having a mortgage stay in place or making arrangements for it that doesn't have to be immediate upon the divorce or within 6 months. You may choose to do that, but there are options that might be more affordable that don't require you to. So something people may think is that oh, an attorney is so expensive. Do I have to hire a coach? Do I have to hire a CDFA? Do I bring in all these other professionals? More likely than not, bringing in an expert in a specific area is going to pay for itself, because they help avoid making mistakes that you can't take back, or they find more efficient ways to do things or more creative ways to do things. And it's likely it's just going to take them less time because they're used to doing it and do it day in and day out, as opposed to someone who might see this challenge, or situation infrequently.
This is like the final thought that we talked about, like the questions you can ask at any point of the process. Is there anything else I should know? What are the tax implications? Are there penalties, and can we actually do it?
Yeah,
talk a little bit about that.
Those are rather like, that's your true north, if you will. Divorce is a situation where you don't know what you don't know, and then you find yourself in it and you have to make all these decisions and you may not know the questions to ask. So this is just meant to give you, like, here are some questions to ask every single time. And then hopefully you can be more informed and avoid making mistakes because you didn't ask the right question. So the biggest one is, can you do it? Can we do what we agreed to do? You want to find that out before it's final. And then ask your professionals, ask your team, what don't I know? What am I not asking? What are the pros and cons? Instead of just a like blanket statement or decision, or do it this way. The people who tuned into this, they want to get educated and know their options. So it's kind of like preaching to the choir, but ask the questions and get educated. Don't just take someone's word for it. If I've seen sometimes professionals who are just kind of, don't worry your pretty little head, trust me, to their clients. You deserve answers. You've got too much at stake here to let those go unanswered.
Well, I have really appreciated all the time you've given to us today, our attendees, and also Brenda for being here. We don't have a lot of time for questions, so I will say you are welcome to contact Advice Chaser, and we're happy to connect you with someone who can answer those questions. And I want to thank both Brenda for being here and the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. And then we did have one question. Yes, we do have a recording of this, and look to your email for a link to the replay of that. And you're welcome to share that with friends and family. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.
Bye. Thank you.